So good afternoon, everyone. Welcome to the next panel, which is on data requirements, disclosure requirements and data challenges. And as Diana has just said, this is a topic which has permeated probably all of the sessions in some way and the topics that have been discussed this morning, because it really does underpin the achievement of all of the significant ambitions and objectives that we have in tackling sustainability-related risks and addressing opportunities. So you've heard this morning about physical and transition risk and taxonomies and the requirement to scale up climate finance and decision-useful data and reporting as a critical dependency for achieving each of these areas. Now, I'm going to say a few words to open, then I'll introduce our very well-qualified panel of experts, which are both in the room and online. So disclosure gaps are one of the biggest challenges that we face. Research from FTSE Russell, which is part of the London Stock Exchange group, has found that about 42% of large and mid-cap companies globally still do not disclose both Scope 1 and Scope 2 emissions. We've seen disclosure varies dramatically across markets, and that there are also major issues using estimates for corporate carbon emissions as well. And these can vary significantly over reporting periods. In this context, it's really encouraging to see regulators on a global basis, and particularly within Asia, proposing to mandate companies to publish their GHG emissions and report in line with TCFD. So these are some of the issues that we're going to be exploring with the panel. As I mentioned, we've got a great lineup of panelists for you this afternoon to talk about this particular set of wide-ranging issues, and I'm going to start by briefly introducing each of them. So online, joining us virtually from London, we have Chris Faint, who is the head of the Climate Hub division at the Bank of England. And Chris, it must be a very early start for you, so thank you in particular for joining us. Chris is responsible for developing and implementing the bank's strategic approach to climate change across all policy operations, and particularly focused on the bank's prudential regulatory authorities' supervisory approach to addressing financial risk of climate change. And we're going to hear more about that as we go through the panel. Hiroshi Komori joins us from Japan and is a member of the IFRS Foundation Trustees International Sustainability Standards Board, the ISSB, which I know many people in the room are going to be really interested to hear about and to understand the direction of travel there. So Komori-san joined the ISSB in September last year, before which he was the senior director and head of stewardship at the ESG division of GPIF, the Japanese Government Pension Investment Fund, which is the world's largest institutional asset owner. So he brings the perspective of both the standard-setting body of the ISSB and also the asset owner perspective as well to this discussion. In person in the room, I'm delighted to be joined by Mihwa Park. Mihwa is head of ESG Analytics Asia Pacific at BNP Paribas Securities, where her remit includes the development and management of ESG analytics solutions and reporting solutions for institutional clients, as well as responsibility for product development and services relating to ESG for BNP's Asian client base. Mark Harper is Group Head of Sustainability at Swire. Mark has worked for around 20 years in the corporate sustainability field and also has a very senior level NGO background. So it's great to have Mark here with us to bring the corporate perspective, which I think is not often enough heard when we're talking about how disclosure and data requirements impact companies in the corporate space as well. So without further ado, we will move straight into the questions. And I'm going to open with a question to Komori-san on addressing the significance and the importance of data. And I wanted to ask you first, from your perspective as both head of stewardship at GPIF and now as a full-time member of the ISSB, can you tell us a little bit about sort of setting the scene on the data imperative and how the ISSB is thinking about its role in driving forward standardization to the benefit of the financial sector, but also maybe the real economy, and how you're going to help to address the existing data gaps? And I think when we were sort of communicating earlier, we felt that it would be helpful to understand a little bit more also about the position on Scope 3 data, which the ISSB has also taken a stand on. So we'd love to hear about that from you, if I can pass the time to you.
Okay, thank you, Helena. Kind introduction. Hello, everyone. I wish I could be in Hong Kong today with you, but since March end, the board member of the ISSB has been terribly busy for our internal process of balloting to finalize our S1 and S2 draft to be publicized within the end of, second quarter of 2023 this year. So therefore, I'm from Tokyo today. And thank you very much, Helena, for the good question to us. First, I'd like to emphasize and would like you to understand that our mission, we are not making our new separate standards now. Listening to the needs of the users in the capital market, we are now trying to integrate standards and rules in the market used many years by both, size of companies and investors in the capital market. So that's why we are now working with legacy CDSB, IRRC, International Integrated Reporting Framework, SASB, and concerning TCFD. And we also had MOUs with GRI and CDP recently. So from my experience as head of stewardship and ESG at GPIF in Japan, I'd like companies' CEO, CFO, Chief Sustainability Officer, and Chief Human Resource Officer, and IR staff and sustainability CSR staff to know that investors, particularly long-term investors, such as GPIF, use data and quantitative information disclosed by companies and provided by data providers or research companies for their evaluation, company by company, sector by sector. But at the same time, beyond the data, they closely watch companies' attitudes and integrity towards disclosure and engagement with investors on self-analysis of risk and opportunities over the short, mid, and long term, current and future business models and their changes, resilience, scenario analysis, etc. So as an example of gap between both sides, such as Scope 3 GHG emissions, investors have well-known challenges of companies, such as serious need of IT investment for gathering data from hundreds of sustainabilities and global group companies, as well as suppliers and clients in their local and global value chain. And also issue of correctness or appropriateness of the data itself under the current scientific technologies. So that's why we will require companies to disclose data, first of all, including Scope 3 emissions, but we know very much qualitative and narrative information will complement and strengthen their disclosures, your disclosures. So I would say that disclosure is not just disclosure, but it is a strategic tool for companies to explain their value creation scenario in the engagement with investors on the long term in a capital market. So I would say that the disclosure would be indispensable on both sides in terms of journey of value creation process in a capital market. Thank you.
Thank you, Komori-san. And I think we're going to hear from Mark in a minute about value creation and the benefit of data in the corporate space as well. But before we do, Chris, I'd like to bring you in here. And following on from Komori-san's description of the significance of standardization and the requirement for data as a bridge between both the users and also the corporates, can you maybe give us some insight into the work of the Climate Hub at Bank of England and what you're doing with regards to climate reporting guidelines there? And also maybe your expectations about how the ISSB is going to have an impact from the prudential standpoint as well. So perhaps I can pass to you to give us some views on that.
Great. Well, look, thank you for inviting me here today. And again, sorry I can't be there in person. But from a central bank perspective, the thing that we're really focused on is risks. The risks from climate change that are going to arise in the future. Of course, we do have some interesting opportunities as well, but really our remit makes us focus on risks. So what we want to do is ensure that the firms that we regulate and the system that we regulate are collecting the information that allows them to understand those risks. And I think the challenge of that cannot be understated, because firstly, these are risks that are going to arise in the future in ways that are often, very often unprecedented. So you can't model them. You can't use data from the past always to determine what those risks will look like. But also it's the kind of data and analysis that firms don't currently collect. There are a whole new set of data points that are going to be required to look at risk. And then third, as a challenge, even if you do collect data today, how can you ensure that you're forming a view of how that will change in the future under a number of different scenarios? Because we know that climate change is going to arise in a number of different ways, but we don't know what the path is, what the scenario is that's going to rise to. So we don't know the combination of risks that's going to arise. So there's a lot of challenges in this space at the moment. Within the regulatory and central bank community, we've been thinking about how can we use our tools to best understand those risks and to allow those that we supervise to best understand those risks. So we've set out expectations within the Bank of England and other central banks for banks and insurers that we regulate to actually start to build up those understanding of the risks and start to think through what that means for the investments, for the money that they're investing. And where they don't have data, to use judgment. And this is really important because there will be data gaps. So they should use their judgment to then form a view on what the risk profiles look like for those institutions. That's been going on for 3 or 4 years. And I think it's fair to say that there's an increasing body of data and information that firms are getting. So we're getting better at understanding risks. But one of the things that has just become unbelievably clear is that you can have 10 different firms collecting the same data and they can interpret it in different ways. So standardization of how that data is collected and how that is reported is incredibly important, because ultimately we don't just want firms to understand risks, we want them to report on those risks. We want their investors to understand those risks, and we want to understand those risks. So this is where the ISSB comes in. The ISSB is going to, I think, be a game changer in the sense that it will look at ways of classifying risks, give some guidance on how firms should be thinking about how they package the data that they have. And over time, that will allow us to not only have more information in the public sphere that is comparable, but it will allow us to evolve that information into areas that we would like it to go into, be it away from climate into sort of broader nature issues. So we do think it's a game changer. I'll leave it there for now.
Thank you. I think that's very insightful, and I think that point on standardization of methodology as well is another one that we're going to unpick in the course of this conversation. And you make the point also about forward-looking data. And I guess that also requires an element of modeling, which then brings its own, I guess, questions in terms of the use of derived data and analytics. But Mark, let me turn to you now. We'll hear from our panelists in the room. But from your perspective, obviously, Swire is very much ahead of the field in many ways in terms of the work that you're doing and the data and disclosure that you're putting out to the market. But I'd love to hear about how you see this from the perspective of a large, diversified conglomerate with multiple international and sectoral exposures, and your expectations of the benefits or maybe the challenges of standardization, and how you might be impacted by that versus, I guess, what currently would be a range of different reporting guidelines, disclosure frameworks. Can you give us a sense of what this looks like from the corporate perspective?
Sure. Firstly, thank you very much to ASFMA for inviting me to come along. It's nice to give a corporate perspective to a group of finance people, so that's fantastic. In relation to the question, I'm very much in line with the previous speakers. I think that ISSB brings significant advantages, not just to the financial services sector, but also to the corporate sector from the provision of data, because at the moment, you often hear about the alphabet soup of different reporting frameworks out there, and the demands on businesses in relation to the amount of data that we're being expected to disclose is significantly increasing. And many of the frameworks are essentially asking for the same information, but in very different formats, which significantly increases the reporting burden. And I have a team of 8 people, and in addition to obviously all of the reporting requirements, we also have the role of managing sustainability and driving sustainability performance across a diversified conglomerate with operations in the real estate, aviation, F&B sectors. And so the complexity associated with all of that and the different reporting frameworks can be a significant drain on our time and resources. So any standardization is a massive plus for us. I think from the point of view of the challenges that standardization can potentially pose, one of the big challenges for us as a diversified conglomerate is that the move towards single sectoral approaches to reporting, so sector-specific guidelines. And that's incredibly difficult for us as a conglomerate, because do we report on a consolidated basis at a group level or an unconsolidated basis on an individual operating company level? Do we, when we're conducting our double materiality assessment, do we do that at a group level or at an operating company level? And how all of that then impacts on how we report gets incredibly difficult via a single sector approach, particularly when all of our businesses, separate businesses, also produce their own report. So the idea of a group report that's essentially just duplicating the effort of all of the different operating companies is a significant waste of effort and resource, and no one wants to read a 500-page sustainability report. So I think that's a significant challenge. I think from a compliance perspective with new reporting frameworks, the timeline associated with how rapidly companies are expected to be able to adapt and report, particularly when the frameworks are significantly different. So at the moment, we're reporting in line with the GRI and the Hong Kong Stock Exchange requirements. But the requirements that are coming through from ISSB around essentially linking the identified sustainability risks with the potential impact on the P&L accounts, that's a significant new change in reporting, and that will require significant capacity building, both within the sustainability functions, but also more importantly in the corporate financing options, because ultimately they're the ones who are going to be providing that data. So if you give companies 6 to 12 months to comply with that new reporting framework, you won't be getting anything of any value back from the organizations. And to a certain extent, I felt that one of the challenges around TCFD was that there was this mad rush for compliance, and that was before a lot of the guidance and the tools had been developed. And so from the point of view of allowing financial institutions to be able to compare apples with apples, companies from the same sector, what you've actually got is multiple companies using multiple different scenario methodologies, and that level of comparability, I think, is minimized. So I think that there needs to be a sense of realism within that compliance timeline. The other one, and data has been raised quite a bit from the previous speakers, that data piece is always going to be a massive challenge for us as a diversified business, pulling together all of the information from the different sectors, pulling it in time. So a Hong Kong Stock Exchange now requires simultaneous release of the sustainability report and the annual financial report, and that definitely poses challenges for us as a business. What we've done to address that, however, is we've essentially developed a standardized data protocol that standardizes the scoping and boundary approach for the business, standardizes the calculation and estimation methodologies, so that all of the businesses within the Swire group are reporting using the exact same methodology and the exact same approach. So hopefully that then can give financial services companies and other users of our data the confidence in the quality of the data that we're actually producing. But obviously that takes time to implement, so any significant changes required by new reporting frameworks will need time to amend that protocol and time for that approach to then be embedded into our internal processes and the data management systems that we have in place.
Thank you. Really interesting. So challenges in the implementation as well as obviously welcoming the benefits of that standardization piece. Mihwa, can we hear from you about the investor perspective? I guess, how are you using ESG integration? How is this being, in practice, implemented into investment decision making? What challenges do you see? And is it sort of at fund level reporting purposes, or is it more about sort of needing to enhance the opportunities for effective integration of ESG data? And in that sense, in what way do you think that the standardization, or I guess the output of ISSB, will be relevant to you and to your constituents and stakeholders?
Yeah. Thank you so much for the invitation. I can talk about the institutional investors' perspective, because I'm in a BNP Paribas Securities Services. So a lot of our clients are the pension funds or asset managers who are monitoring their investment portfolio in terms of ESG perspective. So they currently, we are providing some data and reports for these institutional investors. And I want to share one case that there's one institutional investors that are monitoring the carbon emission, the finance carbon emission in their portfolio. So so we get the carbon emission data from third-party data providers, and although the data coverage has improved significantly over the years, still coverage is not sufficient yet. For example, ASX 300, it's Australia's 3 largest companies, the listed companies, yet about 20 companies out of 300 companies are not covered. So there's no carbon emission data provided by the third-party data providers. So when we talk about small cap, mid cap, or emerging countries, then the data coverage is not sufficient. And please keep in mind that carbon emission data is more straightforward, more standardized data among all types of ESG data sets. When it comes to the bond portfolio, the issue becomes more outstanding, because the companies usually publish the sustainability report at the parent level, listed parent level, on a consolidated basis. And if the data is not disclosed, then third-party data providers publish the estimated carbon emission data in data. But the unlisted companies are out of the attention. So a lot of bond issuance that are issued by the unlisted companies do not have much data. So if the investors are heavy in the bond portfolio, then this data availability, the coverage issue, it's a really serious issue still now.
Thank you. So certainly challenges in the fixed income space and with unlisted companies, and that also then, of course, goes across to the private space on the equity side as well. So we'll hopefully explore a little bit of that also. But Komori-san, can I come back to you, particularly in regard to the implementation of ISSB across jurisdictions within Asia? What are the dependencies there, and what are your expectations, if any? Could you also say a little bit perhaps on some of the regional offices that we know are going to be established within Asia? For example, I know there was an MOU that was signed with the Ministry of Finance in China. It would be great to hear a little bit on that implementation side, specifically with regard to Asia, if you can comment on that.
Yeah, thank you, Helena. This is a great question for us to explain at the moment to our stakeholders in this region. We are now expecting the physical establishment of a Beijing office later this year, and at the moment, we are now planning on how we outreach each jurisdiction of this Asia, Oceania regions. And I now belong to Asia, Oceania office in Tokyo. And I am also a chair of board advisory group of for Asia Oceania region from Tokyo. And we've got the same chairs in Americas region and the EMEA region as well. And as you said, that Beijing, which has a very good history of a contribution to the accounting side at the IASB side in the past to develop IFRS accounting standard to the Asia Oceania region from China. So therefore, I am very much looking forward to a kind of cooperation between Asia Oceania office in Tokyo and the Beijing office under the leadership of our Vice Chair, Jin Dong-hwa, who has a great, career working for World Bank and Asia Development Bank and African Development Bank. So he globally, oversees our development of our engagement to each of our emerging and developing countries, as well as SMEs, small and mid-sized companies globally. So therefore, on the basis of a cooperation, co-working between the Asia Oceania office in Tokyo and the Beijing office, together with Jin Dong-hwa and my colleague from China, Bin Len. And also at the Asia Oceania office, I now work with my another colleague from Korea, Tae-Yan Pei. Therefore, the four members, coming from Asian region, will be working together to outreach our S1 and S2 going forward once we publicize within the end of second quarter of 2023. Also, in terms of disclosure, there are several disclosure tools. I would say that integrated reporting framework is one way, and digital reporting, digital taxonomy is another one. And also, we are going to expand our covering from climate issues to biodiversity and human capital and the human rights issue, as well as connectivity between financial information and non-financial information, sustainability information going forward, based on our, another next public consultation later this year. So therefore, that is another cooperation in terms of, disclosure tools in a way. And also, I'm also a member of, investor group in this region globally, as well as globally. So there because we've got kinds of stakeholders, not only regulators, but also companies, preparers, and also investors, users in a market, and financial institutions for specializing lending, such as banks. So therefore, we have set up such a stakeholder, group, as well as a regional group, as well as a tools group, in a sense. So there are several layers of groups inside ISSB at the moment. I am a chair of a regional group and a member of a, investor group, as well as a member of a integrated reporting members group. So like myself, each of our members have a multiple role in terms of, as I said, in various functions. So that I would say that as a whole, using whole resources of ISSB, not only board members, but also staff people, we would like to outreach to each jurisdiction of each region going forward, beginning probably later this year. So that could be a good way to avoid further fragmentation of, disclosure standards, which we are now experiencing right now. So we very much would like each jurisdiction to adopt our S1 and S2, and then and after that they can add up their own countries, say allowances or additional rules as a building block approach. So that's a plan we are now having in mind. So I very much look forward to visiting each jurisdiction, say in this region going forward. Thank you.
Thank you, Komori-san. So implementation is going to be critical, and it's great to hear that there is a cross-regional network that's going to be in place for that. Conscious of the time, but Chris, I'd love to come to you next and ask you if you can share observations from the climate stress tests that were run last year in the UK in terms of any methodological and data challenges that you saw. Also, what was the response from the banks, from your constituents, and what tools, I think to Komori's point, do you consider to be necessary for the scaling and the accuracy of assurance processes and of getting to a point of convergence and truth in this process?
Thanks. There's a lot in that question, so I'll try to keep it quite quick. So look, we are firm believers in the value of forward-looking analysis. From an investor perspective, you don't necessarily just want to invest in something that is green today. You want to maybe help the transition and see how an activity is going to become more green over time. So the transition is linked to transition investing is linked to scenario analysis, forward-looking scenario analysis. But also, we want to understand how risks are going to evolve over time. Something might not be risky today, but it could be risky in the future. We don't have a clear understanding of what the government policy paths around the world are going to be. So therefore, what we need to do is we need to look at different transition policy paths and think through how might the world change, how might risks change as a result of that. So it was on that basis that we undertook a pretty detailed scenario exercise in the UK. We got the largest banks and insurers to take part in it. We did 3 scenarios looking at different types of transition. One was a transition now, another one was where you don't have a transition, the other one was something in between. And what we asked firms to do was invest significantly to get the data that would allow us to understand how risks might evolve. In terms of what it taught us, I think there were some really valuable insights, maybe things that we could have expected before, but it provided some evidence that they exist. So the first one was that exercises like this really help to harness firms' investment. The discussions and investment in models and capabilities that came on the back of it in banks and insurers was significant. So I think firms being really challenged on what they need to do does create an improved data proposition on the back of it. The second one is that there is just a huge absence of data out there. Financial firms do not have the ability to get all the data themselves. They need to speak to their clients in the real economy in order to get that data. And what we found was that when the financial firms spoke to firms in the real economy and said, well, what would happen under this transition? What kind of risks would impact your business model and your profitability? Often they just did not know. So it shows that you need a whole economy transition and whole economy data transition in order for us to really be able to understand what's going on, which I think does speak to the value again of ISSB and having disclosures across the economy. And the third one is that even when you did have some of the data, there is a huge amount of judgment that is then used to think through what that data means in individual firms. A good example of this is that we had 2 banks, both had the same counterparty, both had spoken to the same counterparty, got the same information, and under the same scenario, they modelled impairments to that counterparty lending. One was 10 times greater than the other. So the judgments that they'd used had created a 10 times differential in the kind of risks that they saw coming out. So what we need to do over time is we need to work together to understand, well, what kind of judgments should we be making? How can we align the analysis that we're doing? Otherwise, there's going to be some challenges with understanding risks. So I guess my headline on this really is that really important for us to talk about data. We need to understand the gaps and the different types of data, but also we need to understand that it's important to have forward-looking data, not just point-in-time data, and the additional challenges that come with judgments when you're looking to develop forward-looking data. So we've got quite a distance to go until we have the full data cap.
Thank you, Chris. Really interesting and important perspectives there. I think we've got time for one more question each for Mark and for Mihwa. And Mihwa, let me turn to you now. We were talking a little bit before about estimations and methodologies that fill the data gaps and maybe the discrepancies between those in terms of different providers. Can you, tell us how you see that from your perspective, but also we talked about PCAP and whether there might be anything there that's going to be helpful in terms of the standardization of those kind of estimation methodologies.
Yeah. So I want to share two interesting cases that I faced in the past. There was one company that did not disclose the carbon emission in 2020. And then in 2021, the company started to disclose the carbon emission for the first time. So the 2020 carbon emission was published by the ESG data providers based on their own estimation. So the number in 2020 and 2021, the difference was 10 times. So does it mean that the company's carbon emission declined or increased this much? Probably no. So that's the challenge. The other case that I want to share with you is that the one company does not disclose the sustainability report. So two ESG data providers come up with their own estimation. And the A's estimation and B's estimation, the difference was 200 times. So when we face these kind of issues, how investors can make a decision? And the reality is that even in ASX 300, about half of the company's carbon emission is actually estimated by the data providers. So these are the real challenges that investors are facing now. So disclosure is really, really important. Moving to the PCAF methodology, this is very crucial and this is very important. I view it as very positively. The carbon emission published by the company is at the company level. So 100 carbon emission is my carbon emission of the company. But when investors buy the equity or bonds, they buy only 1% of the bonds or 10% of the equity. So how much carbon emission should I take the responsibility out of 100? So how can I allocate this carbon emission for my investment portfolio? In the past, different investors used a different methodology. So they use some investors use a market cap, some investors use the market cap, plus the entity that the other person can use the other one. Now the industry has moved toward the one direction, which is a PCAF methodology. So the PCAF uses the enterprise value including cash, which means the market cap of common shares, preferred shares, debt plus minority interest. So it covers all spectrum of the investors. And by using that one standard denominator, so investors can know how much carbon emission of this company I'm responsible for. So investor A is 10% and the other investors 10% will be the same. So this is the direction that industry is moving forward.
Thank you. Mark, we're going to give the last word in the panel to you. We often think about all of this data as being relevant to external users, to the banks, to the investors. But I think what's interesting to hear is how you're using this to drive value internally and to engage internally. Can I ask you to talk a little bit about the value that you derive from all of this data that we're talking about putting out into the market?
Yeah, so obviously the data we collect, we wouldn't be collecting if it wasn't providing us with value, right? And so from the point of view of where do we access value, I guess from an easy one for the people in the room would be in relation to our cost of capital. And so the value there would be a lower cost of capital through access to green finance mechanisms. And currently around 35% of the financing at the group is coming from green financing and principally sustainable linked loans. And so obviously our performance against the KPIs, which is driven by the data that we're collecting, then feeds into sort of the interest rates that we're paying on those loans. Other value that we get from our sustainability data is is around our risk management processes. So we're conducting climate scenario analysis as per TCFD. We've already done a physical climate risk assessment looking at over 850 of our most valuable assets across the group. And that then feeds into the enterprise risk management process, and then obviously the mitigation strategies associated with reducing that risk for those individual properties, those individual assets. Where else is it feeding in? Well, we have, this year we're implementing internal carbon pricing. So actually the data we're collecting is driving performance as well. So we have a real carbon fee implemented within the group, which is real money. So based on the operating company's emissions from that year, essentially that amount of money then has to be set aside in order to for decarbonisation activities. So it's actually driving real-time decarbonisation within the group. We also have a shadow carbon price, which is driving future decarbonisation of the group and driving the overall business strategy in that way. And obviously, processes associated with efficiencies also feeds into the sort of the CapEx budgeting. So all of our businesses are required to submit a 10-year sustainability projection across climate, energy, water, waste metrics. And within that, we then evaluate how that performance relates to the targets that have been set for those individual businesses, and what the CapEx plans that they've attached to either their decarbonisation, energy efficiency, water waste management program. So we can then compare if their projections are below target, then we can look at what the actual CapEx plans that they have attached to that, and we can then say, well, actually, you know, you're not allocating enough money for investment in your decarbonisation activities. So all of that data, all the data we're capturing has a use from an environmental perspective, and obviously we've not really talked about people data and the social side of sustainability, but from a people side, clearly understanding which parts of the group has a higher turnover rate. You know, are we at 50% male and female ratio at entry into the organization? What are we at the different levels of management? Where are we losing female talent within the organization? What can we do in order to attract and retain that? So all of the information we're collecting ideally has value to the organization.
Yeah, great to hear so many best practices. So thank you for sharing that. Unfortunately, we are out of time. I think this conversation could run and run. It's a huge area, and we've sort of scratched the surface. But really thank you to the panel for all of the great sharing and content that you brought to this very rich discussion, and thank you also to our audience. So many thanks, everyone.